If you're not growing, you're shrinking. Oh boy, folks, we have some things to get into in this video here today. First off, one of my biggest investments received a major downgrade here today. It is Amazon stock. This is one of my biggest positions in the public account. Patreon portfolio, I own a bunch of shares in my private portfolios, and they got downgraded here today. Stock moved down significantly. I want to look at the downgrade. I want to tell you my opinion on this downgrade here today. Then we're going to also listen to the analyst. The analyst went on Bloomberg 5 hours ago. We'll listen to their reasoning around this move, essentially, and my opinion on that. From there, we're going to go ahead and I'm going to show you my entire potential buys watch list and talk about what stocks I'm looking to buy next that maybe I don't have ownership in right now. Okay. After we get done going through that, I want to hear Tom Lee's perspective. Tom Lee went on CNBC in the past 24 hours, spoke about his perspective on the stock market, where things are headed from here, all that good stuff. So definitely looking forward to reacting to that in this one here today. I appreciate y'all for joining me. We just got so much to go through. All I need from you real quick, just please hit that little thumbs up icon. If you could just do that for me, that would mean the world. Everybody that's already done that and you didn't even need me to ask, I thank you guys so much for that. Little thumbs up. That's all I ask. Okay. If you guys want to be subscribed to the channel, you want to see more of my videos in the future, make sure you're subscribed. That is, what are we at now? I think 121,000 subscribers, 122,000. So appreciate y'all for being here. Additionally, very proud to announce on this channel, we have a massive sale coming up for 1000xstocks.com that will be on Black Friday. So 9 days from now. Pinned comment down there. Click on that, put in your name, put in your email, put in your phone number so you can receive the deal via text. If you just want to do your email, do it, but you're probably going to end up missing the sale. You know why? Because on Black Friday, every freaking retailer is going to send you a bunch of crap emails about, oh, we're having a sale, 20% off at Hobby Lobby today. Come get your big sale. Like, come on, man. Okay. Oh, half off a pumpkin pie today. Like, you need 1000x. Okay. So do what you want, but make sure you get access to that deal. That will be pinned comment down there here today. And everybody, if you're not in my private stock group, make sure you get access to 1000x. That's the real deal, Holyfield. You have to have access to that if you don't have access to my private stock group. Okay. Alrighty, guys. So first off here, Microsoft, Amazon received downgrade. Now, before we get into the why they downgrade the stock, you might say, how does it just an analyst come out and stock moves down 4% just because an analyst comes out and says, like, you know, we don't like the stock, don't buy the stock? Listen, these analysts work for usually big investment firms, or they work for a lot of Wall Street banks. And so what they say does carry weight. Now, many of these analysts are really bad at picking stocks. Their performance is horrible, okay? Like, very few analysts are actually good. And that's because most of these analysts, they never are actually investors for themselves. They're essentially go to some university, they get their degree, and then they get their first job as some intern at one of these Wall Street banks or investment funds or whatever, right? And then they get bumped up to like some like junior analyst position. They learn from the previous guy, and they finally become like a main analyst. And usually these people, it's not like these individuals built portfolios of millions of dollars of stocks and all that stuff and like had extremely successful track records. No. They just look at a business and they're like, well, this thing, the math says blah, 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 right? And then they go ahead and upgrade or downgrade stocks. And a lot of times these analysts follow each other around. So, you know, you can't really get frustrated at it. It's just part of the game. Like, you got to understand, if an analyst comes out and downgrades your stock tomorrow, like, your stock's probably going down big. Like, that's just a bottom line in regards to that, right? Especially when the market's shaky. If they come out and downgrade when the market, well, keep in mind, when the market's just rolling hot, a lot of times they won't come out and downgrade because they don't want to be on the wrong side of the fence, essentially. Okay, so Rothschild & Co.'s Redburn downgrade both Amazon and Microsoft to neutral from a buy. So basically, he's not necessarily bearish on the stock. He's just kind of thinking like this stock is going to perform kind of what the market does. So if the market goes up 5%, these stocks are going to go up 5%. If they're going to go down 5%, they're going to go, you know, the market is going to go down 5%. So he downgrades to neutral from a buy, as a financial firm does not believe the current titanic investments in artificial intelligence related infrastructure will produce returns justifying the expense. At first glance, Gen AI gross and operating margins are not alarming. Gross margins even resemble those seen in the early days of Cloud 1.0, said Redburn analyst Alex, and in an in-depth report published Tuesday. However, the comparison is misleading. Gen AI margins already assume longer depreciation schedules of 5 to 6 years versus just 3 years in the early cloud era. On a like-for-like basis, this means capital intensity for Gen AI is significantly higher, while pricing power is noticeably weaker. So basically he's saying like this business is not going to be as good as a cloud business 1.0 is, right? And I mean, fair point. That's very, very possible, right? Redburn Analyst finds the net present value for the current generative AI build-out equates to 20 cents for every $1 spent. In comparison, mature cloud 1.0 investments generate about $1.40 for every $1 spent. Now, let me push back right off the bat here in regards to this analyst note, and then we'll finish going through the rest of this, okay? Listen. When you have a new generation of something, it's hard to say what the margins are going to be of that product 3 years out, 5 years out, 7 years out, 10 years out. You can make assumptions, but it's very, very difficult to do that. And so to assume the margins are going to be here, or you're only going to produce 20 cents for every dollar spent versus $1.40 and $1, like those are like very hard. Like no one that's spending all this money on all this stuff right now is playing it from the short-term perspective of like looking at it from how much does this generate over the next year or next 2 years. They're all trying to position for the long-term success, right? And it's not like everybody was super like bullish on the financials of the cloud business over time either, right? And if we go back to cloud 1.0, you had companies like Dropbox, right? DBX. Dropbox was one of the early pioneers in the cloud space. Like they should have been positioned to, have that company be ultra successful. I don't think Dropbox's valuations really moved in the past 10, 15, 20 years, right? Somebody like an Amazon, for instance, like people were not seriously looking at Amazon from a cloud perspective 10, 15 years ago, and they really missed out on a massive opportunity there, right? And a lot of people had a lot of question marks about all that spend Amazon was doing. Amazon's like, oh, we're spending all this, and people are like, I don't know about this. Why are you guys spending all this money? Like, I don't even know if there's a business model for this, right? So you got to understand, like, you're going to have a lot of these questions on a new technological platform or doing something like this. And that's where you have to kind of say, okay, in this new business, like we have to have a little bit of faith, right? We have a little bit of faith that the executives know what they're doing here. And in the end, Amazon's got a pretty dang good track record of spend. Do they not? Like if you think about a company that, man, do they have an impressive track record? It is definitely Amazon. Another key difference is where the value occurs, says the analyst. During Cloud 1.0, hyperscalers captured much of the software layer economics themselves. In the Gen AI era, the value increasingly flows to the model providers like Anthropic or OpenAI, creating value leakage for hyperscalers, at least for the foreseeable future, right? That's debatable, right? You could have said the same thing, I think, in a lot of the 1.0 hyperscale situation as well. So do keep that in mind. Cloud 1.0 refers to the initial rise of cloud computing, which ranged from about 2010 to 2020. It included basic on-demand services like compute, storage, and databases. The key difference between early Cloud 1.0 and Gen AI lies in their underlying economics, the analyst wrote. Cloud 1.0 was built on commoditized hardware serving millions of customers, which allowed hyperscalers to achieve pricing power at relatively low cost. Gen AI, by contrast, relies on expensive hardware and is largely consumed by startups, an audience over which the industry has little pricing leverage. Whether this lack of pricing power is deliberate to attract future winners or simply necessary because higher prices would deepen startup losses is secondary. The outcome is the same. Although Redburn said it is not yet bearish on the rise of AI infrastructure, it is also not bullish, hence the downgrades to neutral from buy. It also has a $250 price target on Amazon and $500 price target on Microsoft. Okay, so before we get into listening to the analyst, let me share my last thoughts in regards to the subject before we listen to him, okay? At the end of the day, these companies are spending aggressively because this next generation of AI companies may be far profitable and far more important than anything we've seen in the past, right? They might scale out their businesses in a much more rapid fashion than anything we've seen. OpenAI, no one heard of OpenAI unless you were super into tech. No one heard of OpenAI 3 years ago, right? Now that company we're talking about has a $500 billion valuation on it and could be going up. Anthropic, no one even heard of Anthropic unless you're insanely into tech 24 months ago. No one had any clue what that company was. And now it just raised money, and I think it's at a $350 billion market cap now. For reference, AMD, the B set is AMD, is at around a $400 billion market cap. So we're talking about these companies in a matter of just a few years are scaling out to, numbers that we've never seen before in history, right? Look at Palantir and how that business has been growing so rapidly, and look where their revenues are trending, right? It's almost shocking. So just understand this AI space. I understand there's a lot of bubble talk, and there's going to be companies that, just are duds in this space. But there's going to be some companies that build out to be far more profitable and far bigger than anything we've probably seen in history, right? Like some of these companies, they might end up becoming the biggest companies in the world 10 years out. Like OpenAI, like maybe they become the biggest company in the world 10 years from now. Like who knows? Maybe that happens. I don't know. Like look at how rapidly they're scaling. They're talking about, going from 13 billion in revenue to 20 plus billion, right? And before they know it, they'll probably be at 50 billion in revenue, 100 billion. I mean, it's pretty rapid in terms of the growth. So, just some food for thought in regards to that. And so these companies like Amazon, Microsoft, all these guys that are spending fortunes right now, they might end up making way more money from these companies long term than actually what they made in Cloud 1.0, and that's something to be considered there, okay? Alrighty, next up here, Redburn analyst on his call to cut Microsoft and Amazon. And remember, the people leading these companies, I think sometimes people forget, like they just assume like, Andy Jassy just woke up yesterday and has no clue how to run a business, right? They assume like Satya Nadella, like, oh, he doesn't know what he's doing. Like, and I'm like, who are you to say like Satya Nadella doesn't know what he's doing? Like, have you seen what this guy's done since he took over for Steve Ballmer? What was that, 10 years ago or so? Have you seen the increase in business? Have you seen the stock price? Have you seen what Andy Jassy's done at Amazon? Did you know he has been the one leading that AWS unit all these years into one of the most successful businesses in the world? So like people act like these guys don't know what they're doing. They're just spending to spend. And I'm like, dude, these are legendary business figures. Like these are some of the top individuals in the world. If all this massive spend from these hyperscalers was done by, some no names you never heard of, and you're like, I don't know who these guys are, right? Okay, maybe you can make a debate around that, right? And they're just getting sloshed with money and they're just spending it out there. But these are some of the most impressive businessmen in the world that are leading the spend when it comes to the hyperscale side, and they've got incredible track records. Even if obviously they don't bring up Meta here, but if you think about Zuckerberg, like that dude's got a pretty good track record, does he not?
Thanks for having me on the show again. As you know, there's like this narrative out there that generative AI is like the early stage of Cloud 1.0, and our work really shows that this is increasingly misplaced. Purely from a capital deployment perspective, we estimate that generative AI deployments require 6 times more capital to deliver the same Cloud 1.0 economics. And that's something that really surprised us in our analysis, and that's why we downgraded heavy-hearted our hyperscalers. So I think it is really the economics are far worse than what we and that the market also believes.
So how does this end then, Alex? Because for these companies, it's been full steam ahead. What becomes the catalyst for them to realize exactly what you're saying, that they aren't producing the results to continue to justify the spend that they're undergoing?
Yeah, I think, post the optimization cycle, generative AI was quite welcome because it gave initially like the growth boost. So
here's another way to look at this. Okay, ladies and gentlemen, you want to talk about exploding growth rates of these companies 2 years out, 4 years out, 6 years out from now? Listen to this. Let's say Amazon, Microsoft, all these companies are, this is going to be very important what I'm about to explain here. Let's say they are undercharging right now. Okay, they're all undercharging for, for their services right now. And the reason they're undercharging because they want to make sure these companies build out to be successful businesses. Okay, so they're all undercharging right now. Well, then as these AI companies get more proven, they make more money, right? They have more success, and they're able to raise more money. Then Amazon, Microsoft, all these companies can go up on price over time, which would then cause their revenues to explode higher if they're way undercharging right now, right? That is something you have to consider. And if you're thinking about where these companies' revenue growth, 2 years out, 4 years out, 6 years out, if you have a company that's, let's say, a very small company right now, but and you're undercharging them, and let's say they're very successful in AI over the next 3, 4, 5 years, right? And they're able to raise massive amounts of money and start making huge revenues, guess what? Oh my gosh, like the amount of money you're going to be able to charge that company is going to be exponentially more than you're able to charge them right now, which means massive revenue growth.
Top line perspective and also operating margin perspective, it doesn't look bad. But where you really have to focus on is on the cash flow generation and the cash flow conversion. And I think what will make them, slow down spending is just that the equities just derate, because it will become more obvious that the economics just don't stack up to what they've communicated.
Maybe now is the start of that, Alex. You are starting to see some of the shares fall, but this downgrade you've issued, it's rare for these companies. There's so much enthusiasm. We were just looking at the Bloomberg screen of analyst recommendations. More than 90% of analysts covering these two stocks have a buy equivalent recommendation on them. How difficult is it to break from the trend in this sector that has a lot of hype, Alex? There's been a lot of careerists talked about of being willing to step away from the pack in stocks that had been red hot until recently. Was that a difficult decision to make just because of the pressure in the success, again, maybe until the last week of these share prices?
I think it has been a difficult one because we have been above consensus for a long time. We have defended these companies for a long time. But I think what is fundamentally different is, just to be clear, the cloud was perfect because the hyperscalers have captured the software layering economics on top of the infrastructure. If you believe that generative AI is big, the likes of Anthropic and OpenAI act as a platform, so they will capture more of the economics. But yeah, we need to be independent, and if the figures and the numbers tell you a different picture, you're just gonna act accordingly.
So what is kind of the balance to strike for these companies that are investing in something that for them and for many people, and most people, that AI holds lots of promise? Is it a case, Alex, of just over-investing, or is it just completely misplaced faith?
So this is, obviously there's so much bubble talk on, are we in an AI bubble or are we not in an AI bubble right now? I'm going to tell you right now if we're in an AI bubble or not. Listen, we are not in an AI bubble right now. You know how I know? Because in a bubble, you do not have analysts coming out and downgrading the most successful companies, the most legendary business leaders of all time. In a bubble, you do not have everybody and their grandma making videos on are we in an AI bubble? Like, I'm seeing YouTubers make videos about are we in an AI bubble that aren't even like stock market investors. Like, they have no clue about how to value companies or like technology like this, and they're making YouTube videos about this, and like it's all over the place, all over social media, and everybody's talking about are we in an AI bubble, right? Like, that's the proof you're not in a bubble right now, right? If we were in an actual bubble, like, everybody would just be on this thing. You wouldn't have analysts downgrading it. It would just be like up and away. And the fact that you have so many questions actually means you're in a healthy marketplace right now.
I think most of the growth in terms of like compute and spending is just still driven by consumer inferencing and also like training, and actually on the enterprise adoption, where API is the best indication, it's mainly software development. So if you were to break it down, it's a software development, so coding, cycling, and they have to invest, they have to be part of it. And I think the risk that they overbuild is significant, because we are basically scaling at a very inefficient stack because they haven't quite worked out, the efficiencies. And that's very different to the cloud, because the cloud really started to scale when it was really efficient. So I think there is an increasing risk there of overcapacity, and a lot of these projects may end up not generating any value at all. It could be negative.
Alex, one of the things that the common refrain of guests that come on here will say, okay, maybe there is going to be this moment of overcapacity, but it won't emerge until 5 years from now, maybe even more years, and it's going to take some time to really realize what the current time.
The thing you got to understand about all this, okay? Listen, I'm going to put you on some game in regards to VC space, okay? The VC space starts getting really excited when they start to see companies get, big valuations put on them, right? If you were an earlier investor in OpenAI, you've made a fortune now, right? OpenAI wouldn't be surprised if that goes up to $1 trillion valuation in the next year or two. Anthropic, they were talking about, $350 billion? Like, who knows, might be not that far in the future, and they may be raising out a $500 billion valuation, right? And you've got a lot of other players in the space. With these valuations getting pushed up in that VC space, that makes more people say, I want to get in this. Like, I want to get in the next OpenAI, the next Anthropic, and they start chasing, right? And that leads a lot more capital to come into the space. And guess what? That leads to a lot more money to be made by companies like Amazon, companies like Microsoft, companies like Google that have these big clouds that are spending aggressively. So you got to understand, like, we're still very early days in regards to that whole cycle, because these VCs, you know, in the VC investors, right? Because remember, it's not just VCs, it's like the VC investors, the ones that are putting money into these VC funds. When they see like Joe over there just 10x'd his money in 2 years because he got into this successful AI, guess what? The next guy's like, dude, I want to 10x my money in 24 months. That sounds amazing. Like, let's go chase after the next one. Like, we could afford to miss some. Even, you know, we take, you know, if we invest equally in 5 companies and 4 of those fail, right? Or don't move much as far as valuation, or in one of them becomes a 10x opportunity, like, we did phenomenal for ourselves. We'll take that every single time, right? It's just math. It's just math. If you're a VC investor, right, high net worth individual, and you put $10 million into a fund and they put $2 million in 5 different companies, and one of those companies goes on to 10x, and the 4 end up either becoming duds or just are flat and you don't really make much at all, or you maybe even lose money, you still made a ridiculous return on investment, right? That's the VC space. Like, you just got to find one that's the next big, huge thing, and you make more money than you ever dreamt. And so just understand, with Anthropic's valuation, with OpenAI, when you hear about some of these other companies getting these bigger and bigger valuations in the AI space, that's going to make a ton more money flood into the next. What's the next Claude? What's the next Anthropic? What's the next, Androl or whatever it's called, right? What's the next OpenAI? Like, they're going to chase, and that money ends up flowing into the big cloud companies like Amazon, Microsoft, Google, McDougal.
Dynamic is. Why go in with a downgrade now? Why not say it's going to take some time to figure things out, but for the meantime, these companies are going to be the beneficiary of an AI build out?
They're simply not the beneficiary. I think the market is telling you already. We've seen a third quarter where across the board, top line expectations have been beat, buy side expectations moved up, and yet the stocks, started to derate because investors have upskilled, and people start to look at the economics much more than the top line. So if we make this call later, it's too late.
It's a fair point, Alex. We're finally looking at more into the balance sheet than what used to be the case for these tech companies of just being like, hey, that's a nice cash pile you have there. May I have some of it? Considering how much things have changed, that these once asset-light companies are now asset-heavy, that depreciation costs start to stack up. Just how different is it to be a tech analyst?
Wait just a minute. Hold your horses for one flip and flapjacking moment. Listen. Amazon has never been asset-light. At least since I've been in the stock market, since I got in 2008, 2009, 17 years ago, right? That company's always been asset heavy. And they're more asset heavy every single year, basically. They have massive warehouses. They got an unbelievable workforce of 1.5 million or 2 million people or whatever work for that company, right? They have all those vans driving all over the place. They have a fleet of planes. They have AWS, massive data centers all over the world. Like, Amazon has never been asset light. So when we're talking about Microsoft, if you want to look at them differently, because you're like, ooh, they're going from asset light to asset heavy, that might be fair, right? Same thing with like a Meta. If you're thinking Meta is going from asset light to asset heavy, you can make arguments for some of those companies. But Amazon's always been asset heavy. So the fact that they're spending fortunes to, position for the next AI cycle and they're going more asset heavy, that's what we're used to with Amazon. That's, we're already used to a low margin structure with Amazon. Amazon's never been a super high margin business. It's not like this is the type of company that has 30% net margins. Like, their net margins are like this much, but they do so much business. They're going to be the first company likely to $1 trillion plus of revenue in the next few years that, guess what? Like, it's fine.
Right now at Redburn, how differently are you looking at these companies as a completely different prospect than they were just a mere 5 years ago?
They are capital-intensive business models, so we have to take a very different approach. And my focus is basically just on the hyperscalers. And I think there's one other point that is quite important because these companies always try to tell you that this is very similar to the cloud 1.0 early days in terms of economics, but it's simply not, because in the early days of the cloud, these companies have assumed a 3-year server lifetime, and now we're starting off with generative AI with a 5 to 6 year server lifetime. So it's very, very different. I think the debate is becoming much more nuanced, and we advise investors to be much more critical.
Hey, Alex, just quickly, because obviously what NVIDIA does also drives a lot of the companies that you oversee. Is there anything on Wednesday that would make you feel more positive about the companies you cover, about Amazon, about Microsoft, about Oracle?
Not at all. No, I think for us it was not a short-term call. This is like a structural issue for the industry. It's not going to change our views.
Yeah, I mean, we'll see. But I appreciate that gentleman. I really do appreciate him. I appreciate him because at the end of the day, these big companies also listen to him. I love these companies to go more into detail in future conference calls and presentations over 2026 about their business model, the economics, like why they're doing this, like more in depth. So although I can disagree with him in a lot of respects, I also applaud him for putting the pressure on, right? So yeah. Alrighty, next up here, let's talk about some stocks I'm looking to buy, including some new stocks here, okay? So what we're looking at is my possible buys watch list. This is my full possible buys watch list here. I have Amazon, Bath & Body Works, Salesforce, PayPal, Nike, The Planet, RH, Kava, Meta. Man, RH is all the way down to 141 now. American Express, Adobe, Google McDougal, Whirlpool, Elf, Chipotle, Cake, Celsius, Estee Lauder, Honest. Okay, so there's three stocks that I'm really looking at to potentially buy as my next stocks when I'm talking about brand new positions that I'm looking to start in. If you're wondering like when would I start these positions, I would start these positions likely January or February. Okay, and so for the remainder of this year, which there's not much of this year left. Keep in mind, we got the holidays that's going to be disrupting trading days. There's only I think there's only 30 trading days left in this year. Like this year is almost done at this point. So I'm already on to 2026. Like 2025 is a thing of the past for me now at this point in time. So in terms of some new stocks I'm looking to buy, I'm looking at RH. RH is a stock that I think if anything is going to go lower between now and year end. It's going to be lower than 141. Continuing to see tax loss harvesting that one. No one wants any piece of RH right now. And I wouldn't want a piece of it either right now. Like, talk to me in 2026. That's what I'm definitely looking at. I like that company for the long term. I hate what they did with their balance sheet. I need to see their next earnings. If their next earnings say, if their balance sheet's improved a bit, if their cash balance is built up a bit, that will give me some more comfort. And if they're profitable on the bottom line, that will give me some comfort as well. So I need to see that. The conference call will be what the conference call is going to be. But, if this market goes a little more south too, and let's say those earnings aren't everything it's cracked up to be, you'll see that stock at 99. Kava. This one I've always kind of pictured going under 40 or right around 40. In December, essentially. So that's what I'm looking at starting a position in. I really like Kava. I ran numbers recently. So on 1000X, we have a bunch of different things you can do on here that's very valuable. But one of the most valuable things is being able to run projections on companies. So I saved my Kava projections here. We made it so now you can save your projections when you're done and then load it up so you don't have to keep running the same projections on the same stocks again. But I've ran projections on Kava and it looks pretty darn good. Like if my base case works out here, which is 20% revenue growth on average, 26 through 29, and 35% net income growth, you could say a 60 to 80p would be fair for a company growing at that sort of growth rate, right? Like you're looking at a CAGR that's 30% plus here, right? So now you could take that down a bit. So here I did 15% revenue growth, 20% net income growth, 40 to 60 PE ratio, which is pretty fair for a company growing at those sorts of growth rates because we're talking about this is about a 3x of the market in general. And the market in general usually trades at a PE in the 15 to 20 range. So that's nothing crazy here. Even in a bear case like that, I still get between a 4 and 15% CAGR over the next 4 years, even under a bear case assumption. And then if the bull case assumption plays out, revenue growth of 25% per year, net income growth of 40%, gets their net income to 282 mil by 2029 and revenues of $3 billion, right? We're talking about, and this is net income margin 9%. This would be a Kava a little more mature at that particular time. We're talking about a CAGR of 40% plus, which is pretty darn compelling. Now, to compare that net margin there, 9%, compare that to like a Chipotle. I think this is very important. We'll pull up the compare feature here. I love this feature. You can compare three stocks side by side. So Chipotle, and then let's pull up Kava here. And so if you look at the net margins of Chipotle, 13%. So to assume Cava gets to like a 9% range, and their net margin's a little messed up right now. Keep that in mind in regards to Cava. But to assume Cava's at like a 9% net income margin or 10% even come 2029, I don't think that's crazy to assume at all, to be quite honest, right? Chipotle's shown you can go to 13% when it comes to their net margins, if not a little over 13%. So just something to kind of keep in mind there in regards to that particular stock. Now, another stock I'm thinking about starting a position in 2026 is right here, Bath and Body Works. Bath and Body Works, like boring business. We all know that, right? But this is one I'm really compelled with. I ran the numbers on this stock the other night and I was like, are you kidding me? Like, this is pretty darn attractive here. There we go, Bath and Body Works. Watch this. So oh, dang it, I didn't save my other cases here. Shoot. But I ran them at a 5% revenue growth per year, 7% net income growth, right? And we're talking about you could get a CAGR in the stock between 25 and 37%. Dang it, I meant to save my other cases as well. Well, anyways, I'll do that later. But Bath & Body Works is actually a pretty compelling stock. Now, as far as stocks I am already positioned into that I want to buy more, right? Meta's even looking like a deal now at this point in time. But Amazon continues to be one that's going to be a huge focus for me as far as buying, right? I like Honest a lot still. I like Estee Lauder a lot still. I even actually like Fubo. I need to add Fubo to this list as well. This is one I was taking a break on buying, but now that the deal's done, that took a lot of risk off the table in regards to Fubo. So Fubo is one I could continue to buy some shares here and there. It's a little more speculative. If this stock, if their margins start to increase quite dramatically in 2026 and if they turn to profit, like real profitability, now that the Hulu deal's done, if they do that in 2026, this is no longer going to be a spec stock anymore, which means I could actually buy this one pretty aggressively, right? EL continues to be a buy. I know it's gone up a lot from those lows it was back in April, but that continues to be a buy. Cheesecake continues to be a buy. Like Cheesecake looks phenomenal at $44 there. Celsius is a buy. Chipotle I've considered potentially starting a position there. Yeah, I mean, I might do something in regards to Chipotle. So I don't have Chipotle numbers here for good old CMG. But if we just ran, I mean, what would be a conservative number for Chipotle over the next few years? Like 5% revenue growth maybe. And let's say maybe like 7% net income growth for Chipotle. Let's say they're much slower growth. And you could say a 20 to 25 PE could be pretty fair for Chipotle under this sort of situation, right? Which is considerably under what they've been getting in the last many number of years. But keep in mind, growth might be slower. Nope. Yeah, Chipotle is a no for me. Let me just delete that one. Chipotle. Whirlpool's interesting. That could be a huge turnaround play if housing gets moving actually in 26, 27, which I assume 26 will be better in terms of amount of people moving than 25's been. And then I assume 27 will be better than 26. And I assume 28 will be better than 27. So Whirlpool could actually be a fun stock to be in from like a multi-year perspective. And Mr. Appaloosa Management, I think David Tepper's been buying a lot of Whirlpool. I think he owns, I want to say $300 or $400 million of the stock now at this point in time. ELF continues to be a buy here. American Express, really love American Express here. I believe I have my American Express projections saved here. Amex, there we go. Let me show you these babies on this one. So here's why American Express is so exciting. It's one of the safer business models you can really invest in my opinion, in the stock market. And under my base case here, I get a CAGR of 20% plus. You know, like, it's hard not to buy that stock with a CAGR, we're talking, 20% range for a base case, for a stock that has that level of safety, right? There's one thing if it's a very dangerous stock and things could go really bad for them. But, I mean, look at even from my bear case on Amex, I still get a return that will probably be in line with S&P 500, if not better. Ladies and gentlemen, that means that stock is a buy. Right, CRM continues to remain a buy. I don't know if I have updated CRM numbers that I've done here in regards to that one. Let me see. These might be old numbers. Let me take a peek here at Salesforce. Oh no, these are pretty normal numbers. I had them doing revenue growth of 12%. I think they're actually going to be a big beneficiary of AI. because of some of their new products they have, and they just did an acquisition that should be closing. That's going to boost up growth very nice in 26 for this company. And I think their net income, it looks like, Benioff's going to lead that company very lean. So I think their net income will go much more rapidly than revenues are going up. And so this is another one I think could CAGR about 20% clip over the next 4 years. So I really like Salesforce here. A stock that's kind of hated, but I think it's a buy. And PayPal, huge buy. PayPal, yeah, let me see my PayPal projections here for you guys. So load data for PayPal. And what do we find? We find my base case for PayPal. I'm getting between a 21 and 29% CAGR under my base case assumptions for PayPal. Pretty attractive, right? Pretty darn attractive in regards to PayPal. So that's another one that remains a buy. Let's get into Tom Lee.
Broadly, with your kind of high-level view here, what do you think is really going on? Tom, let's start with you first.
Well, Leslie, I think the markets are a bit nervous in crypto land, in equity world, because one, we've had a government shutdown, and then there's been doubts about AI valuations and people raising questions about that. So AI stocks have corrected and many growth stocks have corrected. And then in crypto specifically, it's been dealing with two issues. One is there was this big liquidation event on October 10th, one that really was a larger liquidation event than anything seen in history. And the second is because crypto is risk on, I think markets are really struggling with what the Fed's going to signal on December, because, if you end up with a hawkish Fed, it gets crypto investors very nervous. I think that's all creating this downside pressure, but I think the good news is there are signs of exhaustion. I did speak with Tom DeMark of DeMark Analytics, and he thinks there are signs that would look like a bottom that could be occurring sometime this week.
Matt, do you agree with Tom here?
I actually do exactly agree with Tom. I think we're nearing a bottom. I look at this as a great buying opportunity for long-term investors. Bitcoin was the first thing to...
Hold on. Okay, listen. Now, Tom Lee and this gentleman, I'm pretty sure they're very heavily exposed to Bitcoin and Ethereum, right? But you got to understand, if you look at the Bitcoin cycle, the Bitcoin cycle says Bitcoin is not going to bottom until late 2026. Who knows? I'm not going to play Bitcoin from the short side or the long side. I have no interest. All I'm stating is that's something to consider there. And from what I've seen as far as the projections go for that Bitcoin cycle, right, it has gone all the way down to 30K. So I don't know, who knows what will happen with Bitcoin. What I can tell you is very important from the stock market perspective, Bitcoin is, because people look at Bitcoin as a risk on asset. And a lot of times if Bitcoins continue to move down, they don't want to take any risk, right? Which leads to just a lack of wanting to take risk in the stock market as well. So that's something to consider. Also, you can get margin calls in there. I also don't like how many people are calling for a bottom on Bitcoin Ethereum already. I'm like, geez, you know what I mean? That's a lot of bottom calling there. That's a lot of bottom calling, but it is what it is.
Turnover before this broader market pullback. It was sort of the canary in the coal mine, signaling that there was some risk in all sorts of risk on assets. I think it'll be the first thing to bottom, and I agree with Tom. We're getting very close to that point. So I think it's an exciting opportunity, again, for people who are looking out a year or more into the future.
Tom, kind of digging into Ethereum a bit more, what do you think are some of the idiosyncratic drivers here? Are there things that you think may be due for more of a decoupling from just the broader risk environment, or crypto as well?
Well, Ethereum is a smart contract platform, so it differs from Bitcoin, which is a store of value, and in many ways its virtue is that it's inert, and it represents digital gold and a good store of value. Ethereum, on the other hand, is, because it's a smart contract platform, is really the rails where I think a lot of things are going to be built. And one of the big breakouts this year has been stable coins, but it's also been things like prediction markets, and now talk about tokenizing more than just dollars, but equities and real estate and alternative assets and other assets. And a lot of that will be built on Ethereum or layer 2. So I think from a perspective of what the ecosystem looks like, Ethereum is a place where there's a lot of activity taking place, and you can measure it by transaction volumes or transactions per second or even value locked on the chain. And these are all rising. So to us, I think it's a story that still is in the earliest stages, and one of the reasons we consider it a super cycle.
And Matt,
before we go further here, one of the other reasons it's so crazy, these guys are trying to bottom call already on Bitcoin and Ethereum and think it's just going to go up from here, is whenever you're thinking about a bottom forming for the stock market, a bottom forming for stock in general, or crypto for that matter, okay, you need to see something very important. Always keep this in mind for the future. Everybody that's watching this right now, listen. You need to see that stock, that crypto, the market, or whatever in general, do a bottoming formation, essentially, right? So for instance, right here, Bitcoin made like a bottoming formation. So you could make an argument that Bitcoin, was basically in a bottoming phase here because, yeah, it had gone down a lot, but it was kind of like it was starting to bounce and whatnot. As of right now, at least, we see no bottoming formation in Bitcoin or Ethereum right now. Like, it is just straight down as of right now. If you can start to have Bitcoin come back and then kind of stabilize, maybe go down a little bit more and stabilize, then you could, I think, make a strong argument that, okay, we've reached the bottom. But as of right now, like, these babies have not shown any signs of forming a bottom yet. That's just something to kind of keep in mind there. And that's why I think it's like, very just loosey-goosey to just be like, oh, we're at a bottom or we're bottoming this week or something like that.
You agreed. You said that you agree with Tom that it's nearing a bottom. How much of a long-term buy do you think this is?
I think it's a generational opportunity for long-term investors, whether you're looking at Bitcoin, Ethereum, or Solana. To double down on what Tom said about Ethereum specifically, look, I think investors are very nervous broadly about the economy.
Dude, Bitcoin's not even down that much. Generational buying opportunity, it's just so ridiculous. Like, generational buying opportunities are when you're getting an asset that's at 5, 10, 20-year discounts. Okay, that's generational buying opportunity. 2022 was a generational buying opportunity for, you could say, Bitcoin. Bitcoin went down to, 15,000? It was a generational buying opportunity for tech stocks. I mean, you had many of the best tech stocks in the world all down 70, 80, 90%. So, like, all over the place. Nvidia was down 50%. Like, Meta was down 70+%. Shopify, Netflix went down like 70, 80%. That was an actual generational buying opportunity. The great financial crisis, that was a generational buying opportunity in terms of the market in general. Like, you have some of those time periods. Bitcoin's not even down that much. Like, are you kidding me? Like, Bitcoin is not even down that much. What are we talking about here? Yeah, generational buying opportunity. And obviously, these guys are so exposed to this stuff. So they have to. But, dude, Bitcoin's down 1% for the year. 1%. 1%. Generational buying opportunity? What? On a 1 year, Bitcoin's up 2%. Generational buying opportunity, it's just ridiculous, man. In the past 5 years, Bitcoin's up 403%. Generational buying opportunity, whatever, man. And the craziest part is that you don't even have fundamentals to back it. It's not like a stock where it's like, okay, this company has this much earnings, it's trading at this PE ratio, the earnings are likely going to increase by this much per year. No, it's just crazy, man. This is crazy stuff.
About AI valuations, about tariffs, about the broad economy. You want to look for secular trends that are decoupled from that. I think regardless of what happens on the economy in the next year, stable coins will grow tremendously. I think regardless of what happens, tokenization will, maybe 10x in the next few years. Prediction markets are going to be huge. Decentralized identity and digital identity are going to be huge. Ethereum lets you play those secular trends, which are in this enormous growth phase.
So that doesn't mean Ethereum's like directly benefiting from all that stuff. Like, what are we talking about here?
Almost regardless of what's happening.
Some stuff it'll benefit from, not everything.
For me, it's really it's a generational opportunity, and to get in at these prices, I think really is almost a gift for long-term investors. It's a tremendous opportunity.
To get in at these prices, it's down 1% for the year. It's up 2% in the past year. To get in at these prices, has this guy never seen a generational buying opportunity before?
Tom, in terms of just the overall volatility, what are some of the near-term headwinds you're expecting Ethereum to face?
Well, One of them is the industry did suffer a big liquidation event that I think crippled many players and wiped out many accounts. So I think that this, just like in 2022 or in 2020, it does take a few weeks for the industry to sort of find its footing. And I think that's why crypto prices have lagged here. And it does have the signs of that maybe a market maker or two actually is unable to provide market liquidity. And as you know, as liquidity contracts, it's the same thing as the central bank tightening. So it's almost like crypto QT. I think the other thing the markets are grappling with is people talking about the 4-year cycle. Many are convinced that Bitcoin prices have peaked. So in some ways, Bitcoin being the blue chip and the bellwether is important for crypto, because if Bitcoin makes a new high this year, then it really obviates the fact that there is a 4-year cycle. And so it's, to me, between now and year end, I'm pretty bullish on stocks. This sort of weakness in the first half of November was what we expected. But as markets rally, I think that's going to help propel Bitcoin to an all-time high.
Tom, we can't let you go without asking about Granny Shots, that ETF recently celebrating its 1-year anniversary, gathering $3.6 billion in assets in its first year. You plan to expand the lineup. How do you plan to do so, and where else on the court will you be shooting from, so to speak?
Yeah, well, that's right. Granny Shots, which refers to a way of shooting free throws, proved to be very popular with investors, as you point out. And part of it is the performance. Granny Shots, in its first year, outperformed the broader index by 1,000 basis points, and year to date, beating the S&P by more than 1,000 basis points. The idea of Granny Shots is the idea that there are super cycles, themes that last for more than 5 to 10 years, and we want to buy the strongest stocks. So we are expanding the Granny Shots family. That they're going to go effective tomorrow. One is a mid-cap Granny. So this is taking the same Granny model, finding the 7 super cycle themes, but buying small and mid-cap stocks. And it's going to hold more names, maybe 40 to 50 names versus 30 for Granny. And this is going to be a good way for investors to get additional Granny exposure in small and mid. And the second is an income-oriented Granny Shots product. So this is going to be using the same Granny Shots model, but also generating income. So the tickers are GRNJ for small mid cap and GRNI for the Granny income.
So I'm excited to see, how Tom Lee does over time in regards to those ETFs and whatnot there. Specifically, obviously, for his main ETF. And the reason being is, obviously, he's done it for a year now. But at the end of the day, it's been a great time in the market the past year. Fidelity recently had us on a 1-year return of 40 or 50% or something insane, right? So it's been a lot of fun. But the other thing is, how do you handle the bear markets, right? And so that's what we haven't seen with his ETF. How does it handle the bear market, right? I love to look at my 5-year returns, my 10-year returns. That lets me know how I'm doing over time, because, if you're in the market over 5 years, good probability you'll have at least one bear market in there. If you're in 10 years, you probably have 2 bear markets to go through. And then you get to understand, how are you holding up in general, not just on a 1-year basis, right? Because, if you're in higher beta names, higher risk stuff on a 1 year and the market goes up a bunch, you're probably going to go up even more, right? So there's something to kind of keep in mind there. Okay, guys, appreciate you joining me as always. Once again, that 1,000X sale is going to be the pinned comment down there to sign up for the sign up list. And when you join us in there, we're going to send you your Steel membership card when you get that deal. We're going to have a deal on the 1-month membership and a 3-year membership, depending upon how long you want to join. And that is 9 days from now. It's coming up fast. All right, guys, much love and have a great day.